right, next up here, stocks will likely continue their upward momentum into year end.
You're overweight on equities. All year long, you've been saying you don't see recession coming up this year. It looks like you were right. But now, as we see this rally in the markets, what are you expecting this week as we go into a holiday shortened week and also a period of time where we have 2 more inflation reports and also a Fed meeting?
Yeah, Frank, I mean, we have been, and I'll tell you, a year ago, we were saying we thought the market would do pretty well and avoid a recession. It wasn't popular. We've had these pullbacks this year. We've had this volatility. But this week specifically, it is what it is. It's a holiday week. You know, we wouldn't be surprised at all. But a little upward bias is what you tend to see, low volume, low news. But the truth, again, and we talked a month ago about this, you know, we expected a late October low like you tend to see. You know, pre-election years are usually pretty strong. We've talked about the strong consumer. We've seen, you know, a better economy, I think, than most people think. I mean, Frank, we're supposed to have record earnings next year, and we think that's very, very possible as well. That's probably not a bad thing. I mean, the concerns are there, but one final comment. You know, the New York Fed does a survey of consumers, right? We know the inflation consumers. Well, they also look at what, hey, what do you think of the stock market, okay? The recent data that the New York Fed just did showed that consumers are the most bearish they've been on the stock market all year. Okay, so there's still a lot of negativity. And when you have a strong November, you actually tend to have a pretty strong December. So we still.
Damn, man, that's one of the things that makes me feel so freaking, actually, surprisingly bullish over time here. I look out there and I'm just like seeing how many people want nothing to do with the stock market. I'm talking about, you know, just regular folks that, you know, were so like, gotta get in the market in 2021, right? And just like now, no one has interest. You know, I talk to friends and just different people like, hey, you buying this stock? Or, you know, were you buying dip last year? And just like almost everybody has no interest. And the last time it was really like that was around 2009 through about 2014. 2009 through 2014, tremendous time in the market. That's when I had my first big come up in life, was 2009 through 2014. And I got to $200,000 in stocks. And back then, you couldn't talk to people. I try to talk to people all the time and get them in the market and teach them what I know. No one was freaking interested. No one was freaking interested. It was when we had a presidential change and some more people got like bullish on the market because they felt like, you know, their guy was in. Then we started to see some momentum, and then we had a blow-off top situation, obviously, in Rona, right, in 2021, and everybody wanted to buy stocks. And I'm just looking out there, I'm like, where's everybody at? No one's freaking here, and except for a few people, and like we're making all the money, and it's just like it's back to the old days, man. It's back to the old days. It's like underground kings now at this point in time. So interesting how it works, isn't it?
We're gonna be a little higher before this year's done.
Packing a lot in there, Ryan. So I also want to get to some research that you sent and some research that your firm's doing. So right now, we're just about a year away from the 2024 presidential election. And historically, you say that sets us up for a year-end rally and a rally going into that election. We're going to show the chart you sent us in just a second. So give us a sense. That's the historicals right there. Are we set up for that similar rally this year? A very different situation. Not only are we coming out of the pandemic, but we're also having a rally this year fueled by AI.
Yeah, you're right. I mean, there's all these different things that are fueling it. I already talked about some of the negative sentiment, but we do think it's possible. And when I was on with you a month ago, we said we need something to spark this. Let's be honest, Frank, it's probably what the Fed is saying, right? What the Fed is hinting. We think the Fed is done. We've been on record saying the Fed is done. You know, we needed to see shelter starting to come back down. I think that last CPI print showed shelter is finally starting to come down. Shelter and cars make up more than half of core CPI. Used car prices have been down 14 months in a row, year over year, according to Manheim data. And now we've got shelter coming back. So that's the spark. And then also you've got AI, the excitement there. But just the truth is earnings, once again, came in stronger. We had earnings recession. We had negative earnings 3 quarters in a row. That ended. And next year, we expect to see positive earnings, which should continue to drive this year, but also into next year, which is going to be a very interesting election year.
All right, before we get to next year, Ryan, I do want to talk to you about something you just mentioned, AI and all the excitement. I think Microsoft and maybe OpenAI have more excitement than they planned on with Sam Altman and Brockman both being moved out of the company, then taking jobs at Microsoft. Give us a sense. Does this change your sense of the AI arms race, if you will? Does Microsoft, is it still in your mind a leader? Obviously, a lot of the companies involved here are very influential to the market. We're talking Google, Amazon, and Microsoft.
Well, I mean, sure, Microsoft is absolutely still a leader. I mean, the truth again, though, is a lot of these companies have been strong. I mean, I was looking year to date, tech's up like 45% year to date total return, right? Communication services not far off. So it's not just all about the Magnificent Seven, in my opinion, to kind of answer this. We know those big groups have been there. We've seen a lot more participation, but just the AI, history doesn't repeat itself. It often rhymes, as Mark Twain has said many times. Keep this real quick. Mid-90s, the internet was coming. Now we've got AI coming, right? Also, mid-90s had high productivity, Frank. We are finally seeing high productivity in our country for the first time in a long time. Yep. Those are positive things to us that say, listen, are we in a mid-90s scenario? I'm not 100%. Sure, but there's some things to say maybe we could be, which is good for investors.
And companies are running lean and mean now at this point in time, which is also pretty bullish overall. So, okay, next up here. There's a real inflection point in small caps. This should be interesting. And then John Deere's going to miss earnings tomorrow? Does that mean the stock's going to tank? What's going on?
Strategy at RBC Capital Markets in studio. And you know what I'm hoping? That I can understand. Since you're here and I can actually talk to you, I'm going to understand all this. I understand a lot of it when you come up. But you're so good at this. And it is somewhat esoteric, obviously, the option market. And
nice
your point is that people are asking you now, this rally, okay? Yep. What am I supposed to think of it in terms of what options are telling me to think of it? Because they don't trust it. They think it's kind of spotty, not going to last. And you're telling them that, in fact, the options market says there's something going on here.
It has legs, and upon that, too, it also has breadth. So, look, the options market is really good at picking out where there's FOMO. So even if you think back to AMC or GameStop or NVIDIA, the options market tells you when people start getting that FOMO, and that usually exacerbates momentum for a while, right? Now, what we're seeing is there's really an inflection point in the small caps. So IWM, our Russell 2000 ETF, we're really seeing historic bullish option sentiment. You see that through the call demand buying.
Seriously?
And this is something where small caps kind of has had fits and starts, right? We've had a lot of strategists say, the time to buy small caps, and that hasn't really worked kind of the last few years. And essentially what the options market is telling you this time is that you're also seeing that FOMO there, which would be a breadth argument to the market that's been very top heavy.
It would mean that as you say, that the rally
I'll put it like
is
this.
broadening out.
I'll put it like this very simply, okay, in regards to this whole small cap situation, small cap stocks. One of two scenarios is playing out over this next, I would say, 12 to 18 months, okay? Probably closer to 12 months. So one of these two scenarios. The first one is the Russell goes up substantially and catches up to the S&P 500. The second possibility is the S&P 500 is going to crash, Russell's not going to get hit very hard, and those two come together. One of those two scenarios is playing out over this next 12 to 18 months. It's one of those two. And so you can try to guess, is it the S&P 500 crashes and comes back to the Russell, or is it the Russell catches up, right? And I think that really depends on your view of the stock market in general, if you think it's going to be a bullish next 12 to 18 months, or if you think we're going to ultimately crash over this next 12 to 18 months, right? But one of those two scenarios is playing out because these have had massive divergence the last couple of years. It doesn't stay like that for long. Does not stay like that for long. And these two are going to come back together, S&P 500 and the Russell.
So broadening out.
In the past 5 years, the Russell's up like 20% versus the S&P 500's up like 70%. And the Qs are up over 100%.
This end of cycle stuff?
That's not lasting.
I mean, we were just showing a bunch of meme stocks. When you get a bullish sentiment there,
thank you.
Why
are you freaking showing GameStop, dude?
Or towards the end of a move?
Yeah, so I think two things are happening in terms of the nuance. The first is I think people, when they look at this rally, they've said, look, it's so low quality. It's very squeezy, right? But the reality is, and this is from our equity strategist, if you actually look at the names within the Russell 2000 themselves, their balance sheets have actually gotten a lot stronger. And when you look at their debt maturities, where that maturity wall is actually 4 to 5 years out. So I think that there is this misunderstanding of, are we talking about this bucket or that bucket? But the other thing is mega cap tech has to remain okay. And the options market is also saying that the sentiment there hasn't waned. So it kind of hasn't changed since NVIDIA, but it hasn't waned. And that would concern me, obviously, because of the heavyweightness of the tech, but that's also not changing. And you're getting the small caps kind of joining the party.
So I saw in your notes you used the adverb, right? Squeezy. You used the
squeezy.
And by that,
squeezy,
you mean
little wheezy.
Did some of the moves higher are seen as because it's short, people are getting squeezed. Is that what you mean by?
Yeah.
But if the fundamentals are improving and the debt is, you said 5 years out, then that's not what it is. Then it's actually some underlying strength, not just caused by short covering.
I think the problem is both are happening. So when you look at like these most shorted baskets, they're also up. When you look at, we have a low quality basket that we track, which is essentially, negative free cash flow, negative net income, high debt to leverage. Like those are also rallying, very similar to what we saw at the beginning of this year. But what we're trying to say is, yes, those things are happening. However, fundamentally, you are also getting these shifts in the higher quality names too. And it's very, very bullish and very indicative within small caps specifically, to a point where, we haven't seen this level of bullish sentiment in kind of like the last 5 years. And we have seen that in mega cap tech, but we haven't seen it in the breadth that you would see in the Russell 2000.
So why is the market so unloved? Or the recent rally, why is it so suspect to so many people?
Two things are happening. I think one, especially in our market.
Before she goes, let me just answer that, okay? Why are people suspect of rallies in the market? One is the market hasn't gone anywhere for over 2 years now at this point in time, right? So the longer you get in that sort of cycle, the more people just distrust rallies. And the second component of that is still recession worries for obviously next year, right? And so just between those two, bearish sentiment plus recession worry still out there. Whether that happens or not is a whole other subject, but it's just the fact that it's out there. That's why everybody's so, I don't know about these rallies and things like that.
People in general, that there's very little hedging. So there is this complacency in the market. It makes folks ask, why are we so complacent? So I'll give you one stat. When you look at tail protection, so just a market drawdown, how much does it cost to protect? We're below levels we saw since October 7th when the Israel-Hamas war started. Really? That's the market telling you that it's not even pricing in that risk at all. So I think what happens is, you do get these kind of call it like May 2020 style, like a lot of FOMO on one side, call demand, and also the lack of hedging. And people ask, how concerned should we be that doesn't exist?
Does that lead to massive volatility? I mean, is that if you have no hedging built into it?
Yeah, if you're a high net worth individual, right, you got to be hedging your portfolio. Like I'm hedged for next year. If the big one does come and we do tank next year, which, I don't think it's the highest probability, but it's a potential. I'm going to make a lot of money in that sort of situation off my hedges. I got several different hedges lined up. And if things go bad, boom, 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 those are going to be looking really good, and I'm going to be able to flip those with huge profits into other opportunities, right? If it doesn't happen, that's great as well. I'm obviously always so far along in the market that's great for me as well. I have some phenomenal videos inside my private stock group that go into hedging. I think one video alone is like 45 minutes going through different hedging strategies. The more money you have, I think the more you have to at least learn about hedging and try to figure out how can you properly hedge your portfolio. I think that's the way I would look at it, right? If you got $5,000 in your portfolio, do you need to hedge? It's not even worth it at that stage. There's a whole different ball game. If you got $500,000, you should probably at least consider learning some stuff about hedging, right? If you got $1 million, you got multi-million dollars. The more money you have, the more important hedging is. And there's a reason why so many high net worth individuals, why don't just all the high net worth individuals put money in the S&P 500 or in the Qs or something like that? Why do they put their money in hedge funds? Ask yourself that for a moment. There's reasons, okay? There's a lot of reasons behind that. And so, just some food for thought in that sort of situation.
And then suddenly the situation changes over a day or over a weekend or over a holiday period.
Yeah. So look, I feel like
those hedges can print so much money in a big downward market. And then the best part is you get to go and flip that money into positions at just the stupidest, cheapest prices. Or into call options and things like that, when the market's already down 30, 40, 50%, and just make bank. In the alpha you get during that particular time period, it's ridiculous. It's ridiculous. I mean, in a 12 to 24 month span, you can make hundreds of percent. If you're properly hedged going in, and you flip over the long side when the Fed's about to pump like crazy, which they always do, and they cut to nothing, and then they're gonna help out the system, and next thing you know, market fly. Oh my gosh!
As a derivatives person, your job is to just think of you're like Eeyore, basically. Like whatever the worst case scenario is, that's what you stay awake at night thinking about. And the issue is volatility in our market is very suppressed. There are a lot of people who are selling volatility because it's another way to enhance yield. And then on top of that, there's no hedging because hedging hasn't worked at all. So the market was down 20% last year, but if you hedge that market, you're actually down 21%. That's kind of a fail from the options.
Not true at all, to be honest. Because let's be honest, if you thought the market was going to be, have some troubles in 2022 because the Fed was going to be raising rates, you were likely going to hedge against many of the big tech high flyers at that particular time, which many of those stocks then went on to drop from November 2021 through October of 2022. Almost all those stocks fell 30, 40, 50, 60, 70%. If you had hedged going in, all your hedges, which you're going to usually hedge by buying puts, are going to be up hundreds of percent. Some of those would probably be up 1,000% plus. I mean, it would have been ridiculous how much money you would have printed, right? So I don't agree with her saying about, if you now it depends on how you hedge. No different than when you go long the market. What stocks are you actually in, right? It's been a freaking amazing year for me, and I'm sure for some of you guys watching this video right now, you've probably made stupid money this year. Hasn't been that way for everybody. If you've been in dividend stocks, you're probably down significantly this year. Somebody like myself, I'm up 7 figures plus this year. I'm sure a lot of you guys are up 4 figures, 5 figures, 6 figures. Probably some of you guys are even up 7 figures this year. If you're in dividend stocks all this year, you're down significantly this year.
Kind of. So, yeah. and so, if you're a risk officer and that hasn't worked, it's hard to say I'm going to double that up. And so you do get these 2017 to 2018 events where there was a Volmageddon, especially because there was very suppressed volatility. And then you had
Volmageddon, you called it?
Volmageddon. Yeah, I didn't even come up with that. It's just, people call it that, February 2018. And so, look, that is a tail event that I think folks are concerned about. And again, tails are very inexpensive. It's not the most likely scenario.
Yeah, good point. Next one up here. Cam, the stock market is overbought right now. What you get to say here, Cam?
Trying to figure out what you think is the most important right now. Is it the Fed minutes that we heard? Is it what we've seen with earnings and maybe NVIDIA's disappointment? Is it some of the broader stories with crypto? What do you think is most important right now?
We didn't see much market reaction out of the Fed minutes yesterday. We thought that we might see a little bit more, at least in the long end of the curve. There was a really important phrase in there where they talked about how that even if they were going to be cutting rates, that they might still continue QT, which in theory, that would keep upward pressure on rates going into next year. Then really we'll turn to the December meeting because that's where we think it's more important for the outlook for rates into 2024 because we get an update to the dot plot. And right now the dot plot only has 25 basis points of cuts priced into it. That compares to the 100 basis points that's in the market, in the bond market. So that's a pretty wide gap. We'll have to be watching closely to see if that gap closes.
What do you think about the rally we've seen to this point in equities, just based on what's happened with yields coming down?
Yeah, certainly that's been the kind of wind beneath equities' wings to have yields moving down. We also know that we have these seasonal dynamics, and I think it's really important to note how different they are versus last year. Just because last year, the largest weights in the index were down a lot, so they were big tax loss selling candidates. Yep. This year, the largest weights in the index are up a lot, which means that people probably are not really wanting to recognize tax gains into the end of the year.
Which also means when are some people are likely to take some profits in regards to big tech companies and a lot of these big stocks that have done very well this year. They're likely going to take some of those gains in the first quarter of 2024. That's a probability, a high probability that there will be some level of profit taken, and probably a pretty decent level of profit taken in a lot of those big techs, especially if Santa comes to town in December and we roll for December as well. High probability. By the way, let me check in on the market. I want to see how my stocks are doing here today overall. Alrighty, let's see what's going on out there. So, Honest is honestly going crazy right now. Honest is just being a freaking beast, man. That stock is on a roll, 51% in a 1 month. Amazon's my second best stock today. Interesting. Cake, Avant, PayPal, Elf on a Shelf, Mattel, Shopify, Meta, Skyworks, Texas Roadhouse, Revolve, Wynn Resorts, Qualcomm, JP Morgan, Pfizer, all green. And then we got Target, Palantir, Fubo, Foot Locker, Tesla, JWN, and The Planet as the Red Dead Redemptions out there today. So overall, pretty good day. Not the best day in the world, but we'll take it. It should be a in the green day. Let's just call it that.
Have things like window chasing or window dressing and positioning chases.
Yes,
it's probably why we're seeing so much strength. And then we'll have to really assess where we stand on things like positioning and sentiment and valuation once we roll into 2024.
Yeah, that's what I was going to say. Do you buy this at this point? Is this a time where you would say we'll step in even with the gains we've seen? Do you think the run continues, or are you worried about a pullback at some point?
Well, I do think that we are overbought right now. So in a very short period of time, respecting the fact that you've moved up very far, very fast, being overbought isn't necessarily a bad thing in the medium term. It can sometimes be a sign that people are just clamoring to get into the market. But I think over the very short period, having some digestion does make sense. But I think if you're looking to buy into this market, it really depends on your time frame. In a short period of time through the end of the year, maybe you do have those seasonal dynamics that lift, but then you have to remain disciplined to say, where are expectations? Is everybody already on the same side of the boat, expecting a very strong market into 24? And then at that point, you might get a better chance to add to positions if you are underweight.
Yeah, I think the first quarter and second quarter of 2024 could be actually interesting buying opportunities in some of the bigger companies specifically, right? Obviously, right now, I think it's been a tremendous time, over this past few months to start buying dividend stocks, a lot of small caps, things like that, right? And a few growth here and there. But I think if I looked out to the first quarter, second quarter of next year, I think it'd be really interesting potential time to be a buyer of some of the big dogs, because I think there's a pretty decent probability some of those big dogs could be in a tougher place in the first quarter and second quarter because of all the momentum they've had. And I think there's going to want to be a lot of profit taking. I just really do, right? And then you'll have all the new worries about the economy and all those sorts of things that will obviously, everybody will start talking about again. Now we're in kind of the holiday season, so that's going to take a little bit of a back burner. But then come January, February, everybody's going to be talking about, this is going to happen, that's going to happen, unemployment, all these sorts of things, okay? Next one up here, potential economic slowdown is likely to be short and sweet.
So just since you referenced it, Lori Calvasina from RBC out with a 5,000 target for the S&P for next year. Just want to mention it because you talked about it. But I want to say
5,000 price target for next year? If we don't have a recession, it's accurate. If we don't have a recession, 5K. It's in
current situation right now.
Probably going to happen.
What's your take on what you're seeing again? We saw bond yields.
So S&P at 5,000 by year end 2024. And I mean, if we don't have a recession, we could approach above 5,000. Sentiment setup is constructive. Valuations can stay higher than many realize. Small caps intriguing. Heck yeah.
To a 2-month low, 4.36, bouncing back up again.
They've been intriguing for 2 years.
I feel like a lot of people I talk to want me to get worried about the situation. And I really appreciate the positivity from my colleagues. But, a lot of people want to talk to me again about the yield curve. Like, honestly, I think I'm done talking about the yield curve. Let's just leave that aside. Or they want to talk about durable goods orders disappointing today. Or maybe Deere's guidance, which we'll get to later. Or Cisco's guidance last week. And I really think the point is being missed both in the microscopic and the big picture. The microscopic, let's just do that right now. Jobless claims. We were supposed to get worried last week when they popped, and now they're right back down to where they've been hanging out, right around 200,000. And that is very important, folks. If people are employed, they're going to consume. Consumption is 70% of this economy. I get it about consumer delinquencies. I get it, about running out of savings. But here's the bigger point, is that let's just say I'm wrong. Let's dance with this idea for a second. Joe got very excited there. It's like he's going to dance with me on this. No,
I'm actually very calm, but...
Your eyebrows raised. For you, that's very exciting.
I'm trying to stay awake while you're talking.
Let's take it down a notch, guys.
Oh, damn. This is why you don't try to banter or argue back and forth with some East Coast folks, man. They got comebacks for days. They got freaking comebacks for days, East Coast people. That's all I got to say.
It's not a-
Boston, Philly, New York, man. You don't argue with those guys or try to go back and forth, because I'm telling you, they got 10 comebacks ready for you at all times. It's a different breed. It's a different breed up there, man.
That was good. Okay. Let's just say that I'm wrong and that there is a slowdown that's occurring right now that's bigger than I expected. Let's just say I'm wrong about the economy skating through there. You know, it is likely to be short and sweet if there's a slowdown. These guidances that we haven't liked, I mean, the fact that next year's earnings estimates have come down as the third quarter results have gone up.
Barely.
Okay, but they certainly haven't integrated the excellent third quarter results. Look, people are still thinking this is going to be some clear the forest floor fire. But all the imbalances are out, right? All the crypto, NFT, meme, SPAC stuff, that was done 2 years ago. You don't have a housing boom. You don't have a tech telecom boom. There's no overgrowth in terms of investment that needs to be cleared out with some brutal recession.
So wait, Jim.
If we're in that slowdown, Frank,
right? That you're not worried about, to be clear.
It's likely to be done really quickly.
Yeah, we are getting
okay. I'll have to take the bearish stance in this one, okay? We could have said that same thing going into the great financial crisis, right? Could have said the same thing. Like, if you look at the stock market did not seem like it was in some sort of big bubble or anything like that. Obviously, crypto wasn't even around back then. NFTs and things like that weren't even around back then. People looked at the real estate market and thought it was just fine, and obviously it wasn't fine, and we had huge damage to come. So to push back against that, you can still have a lot of problems, even if it doesn't look like a problem at that moment.
Third quarter GDP next week, so that's something to watch. You mentioned the slowdown. We'll talk about it a little bit later in the show. But Joe, I know you want to jump. You're trying to stay awake while Jim's talking. I just wanted to come off your one-liner. That was a good liner.
No, but I think the premise that you have is that the fundamentals of the economy are strong, but I'm not sure that's the catalyst behind why the market's rallying right now.
It's buying you.
And I think, I think when you turn the calendar into January, I don't know if that is going to be the thesis, that the economy is overwhelmingly strong and we could take the handoff from a nice Q4 rally into Q1 of next year. I think it has to be that the Federal Reserve sits with their hands, doing nothing, and that the economy shows the signs that it's showing right now, Jimmy, where I disagree with you somewhat, where yes, in fact, the consumer is more cost conscious. And in fact, it does look like we're seeing a little bit of deceleration in the economy. And I think that's a good thing.
Yeah, 100%, okay?